All righty. Welcome, everyone, to this week's Sunday macro wrap up for Sunday, May 11th. Happy Mother's Day to any mothers out there. I looked at my statistics on my viewership, and I think there's only about 2% of viewers who are female. And of those 2%, if you are a mom, happy Mother's Day. For the majority of men that watch this program, I hope you had a fantastic Mother's Day with the mothers in your family. But with that, we'll go ahead and get right into it here with today's Sunday macro wrap up. We got a good one for you because we have a pretty busy week coming up here in the macro world. And so I saw this meme here on X, and I thought it perfectly characterized this interesting environment that we're currently in right now. Whereas, it seems that a lot of power has been put into Trump's hands, not only with obviously all the power that comes with the presidency, but right now the market is just hyper fixated with any type of tariff resolutions. And the thing is that still increases uncertainty because you don't know how the market is going to react to any of these, because we just don't know how the real economy is also going to react to these. And so it's not just the market as well as the market participants. It's actually policymakers as well. And so, as we saw this past week, we had the third Fed meeting, and essentially they're staying uncertain as well. And pretty much Powell went on there, and it was a whole hour and a half talk for them to basically say, I don't know. I still don't understand why they go on TV and even have press conferences, because they're pretty much useless at this point. But yeah, they are holding policy rates steady until they see more resolution on the tariffs. Now, I think that's just an excuse, because when you look at the real data, you are starting to see a positive rate of change in inflation. And of course, we get inflation data this week for the month of April. And so we're going to be covering that in this session. As well as we're having a little bit of a signal in the credit markets that I don't really hear too many people talking about. And so we're going to be getting into that momentarily as well. Now, when talking about policy rate, even looking towards the June meeting on June 18th, we can see that there's an 82.7% chance that they're going to remain paused, right? So right now, the Fed funds is at 4.25 to 4.5%. And that means that mortgage rates, credit card rates, all these things that are still headwinds in the long term, right? There's a huge lag with all this, especially with the amount of money printing that they did. Rates are still high. And so that is restrictive on new credit. But then if we take a look all the way out till December, there's right now, there's about 75 basis points of cuts being priced into the market. 150 basis point cut and 125 basis point cut. When you take a look at this over time here, you can see that SOFR has the Fed funds at 3.5% by December 31st, 2025, the last day of the year. So we'll see what happens. This was definitely a lot. This was 25 basis points higher than it was just a month ago. So that means that the market is pricing in less cuts. And so that means that the Fed's getting more hawkish, and we're not just seeing it here, but we're also seeing it on the yield curve, which we'll get into here momentarily as well. But essentially, all of this is to say that yes, the announcements by Trump about the tariff resolutions are important, but the amount of damage that it's already been having on the economy is just further pushing out the inevitable, which is a slowdown in the economy, which, some people have said that there has already been, and we've seen this in other data, that there has been slowdowns in select pockets of the economy, but there hasn't necessarily been an aggregate recession yet. And my team and I, looking at the macro data, we don't necessarily think from looking at the macro trends that there is going to be a full-blown, crazy, all-out crisis recession. And if anything, you might just see a slight earnings slowdown. But as of this point in time, there isn't really a crazy crisis jumping out at us from the data that we look at. And so, yeah, there's a lot of different moving parts here. But let's just go ahead and get into some of the data from last week. And we'll be getting into the charts here momentarily. So just 1 second. Let me go through some of the macro data. All right. So at the beginning of last week, we saw that the services PMI, which is one of the leading economic indicators for the services sector of the U.S., which is a large sector, right? It's over 3/4 worth of the consumption metric in the GDP number. That continued to slow down, although it did have a slight rebound, and it's still above the contractionary 50 point, and that was led by new orders as well as prices. So that could be viewed as growth coming back, but then at the same time, that also means that inflation could also be rising as well, and so that still makes the Fed reluctant to cut rates at this point in time. Also, as well, when looking at the S&P Global's measure of the services sector in the United States, that also fell to one of the lowest levels, I think, in 13 months. And so you're still seeing a slowdown in the services economy, which has been accelerating pretty much since the market bottomed in 2023. A positive and accelerating services sector in the United States is really a key measure of the strength, and that has had a large weakening, and it continues to weaken. We also got the trade balance last week, which continued into a large deficit due to the tariffs. And so this is what I mean is that tariffs are going to be enforced no matter what, right? So we're not going back to, as long as we're underneath Trump's administration, we are not going back to where it was beforehand. There is going to be some sort of tariffs in place. And so with that, I think a lot of the optimism is just a whiplash of the advanced pessimism that we had back in March and early April. But we're still seeing a deficit in the trade balance. So that's going to continue being a headwind for GDP. And so that was really the main things that we saw last week. What we also got was credit reports, right? So there are two main credit reports that my team and I pay attention to that come from the Federal Reserve. One is the G19, which is consumer credit. And then the other one is the H8 report, which only has to do with commercial banks. So you can think of these like JP Morgan Chase, consumer banks specifically, whereas the G19 report covers more so like all holders of credit, right? So this could be banks, non-banks, unions, credit unions, things like financial companies, right? SoFi, auto lenders. So this is the G19 report is more of like a broad scope. And then you have the H8, which is more narrowed down to consumer credit. Anyways, in the G19, this chart was being spread around on Twitter or on X. And this shows that revolving consumer credit is negative year over year. And it's been that way pretty much since December of 2024, which typically is a leading recession or a coincidental indicator for a recession. And so, but at the same time, when you look at, so this is the G19 report, when you take a look at consumer credit for the H8 report, you can still see that it's been having a slight acceleration over the past couple weeks, and it's not negative year over year. Now, this doesn't mean that these two signals are contradicting each other, right? It's actually signaling more so that consumers overall are slowing down their amount of credit that they're getting into, or they're deleveraging, meaning they're paying down a lot of their credit card debt, or they're trying to reconcile a lot of that debt and extend it out if they can, right? And most of the lending is being done by institutional lending or on the government level. And so that's absorbing a lot of the negativeness in the consumer era. And so this is classic, late cycle type of mismatch, reflecting systematic credit fragility. Okay. So they're not contradicting each other. It's just showing two different measures and telling a decent signal story on the signal right now. And so that's what I'm looking at. And so this is more so credit stress, and these are cracks beginning to form, right? It's what I'm paying attention to. And again, I haven't heard anyone really talk about it that way, but these things are readily available on Fred. Anyone can look at these. So I would highly encourage people to look this up for yourself and not just take my word for it, because this is all public information. So in summary, we're still seeing the real economy start to shrink. We're still seeing, or we're starting to see cracks in the credit market, which again, that's probably one of the most important aspects of the entire debt cycle in the United States. And the consumer is still very much bearish. I mean, if you take a look at the American Association of Individual Investors Sentiment Report, it showed that yes, individual investors and traders, they're still less bearish than they were a week ago, but they are still way net bearish. And so what that could mean, as well as we get the updated Michigan Consumer Confidence Report, or is it inflation expectations this week? But anyways, the consumer is still hurting really bad. And so they're tapped out. And the big thing is that with these tariff increases going on, because even if they do take some back, again, there's still going to be increased tariffs net because of all this. I see the big target between now until the next couple years. It's going to be hitting margins of businesses. And so I think this is all going to result in a margin crunch, which could be a headwind, in the next, throughout these next couple of years, or just increase the volatility of for traders, right? It's not necessarily going to be a buy and hold type of environment, which is what we've been seeing so far over the past couple months, right? Now, taking a look at the schedule, we have CPI on Tuesday. That comes out at 8:30. We have the NFIB Small Business Index, which for me, that's a huge report for leading economic indicators. Small businesses make up over 50%. That's the reason why they call them the backbone of the economy. And so this, in my view, should be a red folder within Forex Factory. Let me zoom in here. I know it's a little bit hard to see. So we have CPI on Tuesday. We have producer price index on Thursday, retail sales. And then we have, I guess, Fed Chair Powell is speaking at some type of conference in Washington, D.C. That's in the morning on Thursday. We also have the housing market index, some Philly Fed, New York Fed manufacturing, as well as some building permits. And then we have, on Friday, we have University of Michigan consumer sentiment and inflation expectations. So this is a way bigger week than last week in terms of macro data. So there's a lot more catalysts this week. And usually the first week of every single month is labor market data, and the second week is inflation data. So that's what we're seeing this week. Just to give you guys an update of where we're at in terms of headline inflation and core inflation. Right now, headline CPI is at 2.4% year over year. This has been a 2-month deceleration from the January 3.0 number. Right, so we are still in a period of disinflation. Looking at core CPI, this has had a more pronounced decline since January at 3.3%. We are now at 2.8%, which is the lowest that we've seen since March of 2021, or around April of 2021. Okay. The big ones, which is the shelter component, that continues to come down, which is bringing overall inflation down, right? So the big components of the CPI report are obviously food and energy, which they get excluded in the core CPI, but then you have services as well as shelter. Those are the big ones. And so shelter continues to come down. as well as services. This is services less energy services, true measure of services. This has been dropping pretty quickly so far in 2025 from 4.3% all the way down to 3.7%. And that's at its lowest since December of 2021. Okay, so these other components of CPI are coming down, and they're very large components that have been pretty sticky over the past few years, right? So that's going to contribute to the disinflationary aspect of the print. But then when we look at commodity prices, those have remained sticky, right? So these are input prices of the economy. That's why we've been seeing a lot of manufacturing data remain higher as far as prices go. And so when taking a look at the Cleveland Fed's inflation nowcast, you can see here's their April forecasts. So this week we get CPI and core CPI, which is what we just covered. They have CPI going from where it's at right now, from 2.4% all the way down to 2.3%. And then they have it rebounding back in May to 2.4% again. So all in all, the Cleveland Fed is anticipating sticky inflation. And then with core CPI, core CPI is at 2.8%. The Cleveland Fed has this staying at 2.8% for the next two prints. So that's what the market is pricing in right now. Okay. We have to understand that, because if you get something that's lower or higher, there's going to be different reactions in the market. Now, in this channel, our goal is to not try and predict these outcomes, because that's impossible to do. And that's not really how you make money. That's how you gamble. And we are trying to make sustained long-term money by implementing our risk management process. And so typically for me and my team, what we do is we tend to look at the setup on the charts going into these events, which we'll get to here momentarily. But the market is also being optimistic, because as what we know from the past couple months, in the headlines, there's been a large focus on the Cleveland Fed's GDP nowcast. And this famously over the past couple months has been negative for the Q1 GDP forecast. And now for Q2, it's showing 2.3%, which is a large acceleration compared to, last month's negative print. And so the market is viewing this as, oh, wow, this the Atlanta Fed has growth rebounding. That's something that's positive. And at no surprise, you've also seen the yield curve start to flatten. And so this is contributing to a more hawkish Fed as well. Right. So this is all pretty interesting things all happening at the same time. And I'll summarize here in a second. But just going through some of the other stuff for this week, we have Walmart reporting earnings. When is that? 5/15. I think that's, what day is that? That is on Thursday. As well as Alibaba on Thursday morning. So those are both in the morning there. I think, I'm not sure what is the previous week, but those are the two big ones. And all this to say, because a lot of people have been sending me messages and they're so focused on the S&P 500, which for those of you that are paying attention to the bookshelf color, it's still red, although it's less bearish than it was a couple weeks ago. But the trend in our model is still in a bearish trend, which is still making me a little bit hesitant. It is on the verge of going neutral, though, so we'll see how this week shakes out. We will know for a fact if it's going to go neutral or remains bearish this week, one or the other. But it doesn't really matter, though, because when it comes to bullish trends, look at the S&P 500 here versus gold. This has been the whole start of the year. The market is down over 24% compared to gold. Do you hear anyone in the news or mainstream media talking about gold? Because this is where the bull market is at. People are always asking me, "Oh, are you bullish on the S&P?" It's like, you guys look at what the actual bullish assets are doing right now. Gold has been making all-time highs essentially for the past 4 months, and if your money was in that instead of the S&P, you're having a great year, which is what the macro process shows us and it reveals to us these different asset classes to invest in while we wait for the S&P 500 to decide what it's going to do. And so when people ask me questions, what are your thoughts on the S&P? And I say it doesn't really matter, and they get upset. Well, it doesn't matter because there's other bullish assets that are performing way better. Okay. My whole goal with my team in this channel, as well as our research communities, is to help people realize that you don't have just two options. It's not just S&P, the Mac, or I guess 9 options. You have the S&P Mag 7, you have the SPY itself, and Bitcoin. There's more to investing than just those. Now, I know people like to also mess around with 0 days to expiration options and all that stuff. That's gambling, by the way. That's not investing. You can have fun with those. That's great. But when it comes to having enough capital by the time you retire and compounding that over time, that's what we're here to help you do, right? So you should have, the way that we set it up is that you have your trading account, which is like a bonus for your income every single month. And then you have your retirement account, which is what you're trying to compound so that you have, millions of dollars by the time you retire. Both of which matter when looking at macroeconomics. So there's that. But also as well, we still want to play towards the bullish trends. And my research partner last week, because our model went bullish on Bitcoin on April 23rd. And then we've been patient for a dip. And my research partner, Aaron, in our partnership circle group, he put in an ETF update for IBIT, which is BlackRock's Bitcoin ETF. Essentially, it's where we signaled the buy. And since then, it's up 10%. And so that's why we want to let things confirm their bullish trend, wait for a pullback on lower volume. That's where you execute, and boom, that's what happens. All right. So I had some people on Twitter, saying that, because you're posting, bearish data, which I wasn't. I'm just posting the math that I'm seeing from our model, that you're missing out on Bitcoin. But that's, as you guys know, that's not true at all. Our model is agnostic to whatever feelings people have. And so, yeah, Bitcoin's bullish in the model. The S&P is not. We'll see what happens from here, but doesn't matter. We're getting paid anyway. And if you guys want to learn how to incorporate all this macro data into your process, for those who are joining on the live stream here, I highly encourage you guys to check us out using the link in the description below, or you could just go to macro-optics.com and check us out there. But now let's get into the charts. So I have a couple of charts here. No one's talking about the all-time highs in the Eurozone markets. So the appetite for foreign equities is still a lot higher than the S&P 500. So no one's talking about this bull market either. We already talked about Bitcoin. We already talked about gold, which is having a nice little dip here. Also silver as well. There's other things. Now, when it comes to volatility, this remains this is going to attempt to get below 20 this week. And if that does, then I would definitely, if this gets below 20, I can definitely see the S&P 500 going neutral in our model for the first time in about a month and a half. And so I'm paying attention to the VIX like a hawk this week. What's interesting is that you're also having a bump in oil as well, even though this oil remains in crash mode. Oil is something that looks like a way better bearish trend to short than something like the S&P. One of our group members actually asked us, if this is a good time to short the market. And first I say, what market? There's tons of markets. Oh, you mean equity markets with the S&P? Well, the S&P 500 is less bearish than something like oil. So which one do you short, right? Let's see. China is getting back to bullish trend as well. So again, capital outflows from the United States into foreign equity markets, that's a headwind. The S&P 500 itself is still at a lower high than the bounce up to 57.84. Let's go to the SPY for those people who are just used to these prices. What the bounce up to 575. It has a little bit of work to do to get to that point, but it's still, look at this drop off in volume here. Let me zoom in. You guys see this drop off in volume? So there's that. Same thing with Qs. Qs is right there as well. And again, this could push up further. In which case, if the S&P 500 was to push up further, I would like to see it close above 575 and have a clear breakout on higher volume. But again, we have to wait and be patient for that. While we do wait for that, again, there's other bullish trends that are making us money. Mag 7 stocks still remains in a clear bearish trend. So the hyper concentration in the Mag 7, I wouldn't be surprised if a lot of people start to clear out from here. And so even if you are someone who's bullish on this, you're taking profits either way. If you're a bear, then you're bearish. If you're a bull, you're taking profits anyway. So double sells on that. And that's pretty much all I have for now. For those who are joining us on the Zoom call right here, hold on one second. But again, for those who are joining us on the live streams, if you guys would like to join us, because the way that these Sunday macro wrap-ups work is that they're an hour long. The first 30 minutes is streamed, and the last 30 to 45 minutes is reserved for our members. And if you guys want to join the discussion for after, again, you can check us out and start a 7-day free trial of our macro investing community. But that's all I have for you guys here on this Sunday. I hope everyone had a fantastic Mother's Day. Those who are in the group on the Zoom call, hang tight while I go ahead and say goodbye to YouTube and Instagram and TikTok. Bye, everyone. Have a great rest of your Mother's Day.